Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
So welcome back to the Sparta Market Outlook Podcast, your inside track on the latest in the energy markets. I'm your host, Rachel Williams, and today we're diving into a seriously dynamic moment for oil. Prices are down, geopolitics are heating up, macro signals are mixed at best, and physical markets are shifting under our feet. So there's a lot to unpack, from the potential impact of secondary sanctions to why diesel might be the canary in the coal mine for a broader market turn. So joining me today are both Neil and June. Hi both.
Hi.
Hello.
And we're going to be covering what's driving the recent price moves and why some of it might just be the market hope over hard fundamentals, what's happening in the physical crude markets and whether we're reaching a turning point. And as always, we'll be getting into distillates and the fascinating signals coming out of the US Gulf Coast at the minute. So look, let's get into it. Why don't we start with where we usually start, actually. So Neil, what's new this week? So prices have dropped about $5 since our last episode. There's a lot of noise around trade deals and macro hopes. So what's actually driving the market right now?
Yeah, I'm just looking at the Brent flat price chart as we speak, and we're going lower and lower. So I guess TI is now at 59, something like that. So it's actually very crazy. I'm not quite sure what's happening on flat price, but there's obviously some conviction that we need to price this way, and we're going to talk about it later in terms of structures. Very interesting at the moment in crude as well. So we'll pick that up in the further segment, but we're actually contangoed in Q4 now, and sort of July, August Dubai swaps are 5 cents or something. So we're basically waiting for contango. The only funny thing is Brent has been super backward, the very prompt. Yeah. So we'll talk about that. But flat price is really down. It's funny because there's now this sort of gap opening up between, let's say, the stock market. So equities have remarkably, basically, gotten rid of all the losses from the last few weeks. And I think there is a lot of hope with regards to, let's say, a lot of deal making, and that the global tariff burden would end up quite a lot lower. But, you know, it's headline driven, it's back and forth. I'm pretty convinced, not that I'm an expert, I'm quite convinced that the signal that the equity market is giving us is kind of wrong just now. And
it does feel like a bit of a dislocation between kind of our oil markets and the equity markets, though, right?
Yeah, and I mean, it's not altogether that important for us what the equities are doing, except for when there's big moves on the day, you know. And the market's really interested in, we're basically waiting for bad macro data, and one of the ones that move the market, I guess, a little is, you know, the sort of port congestion data and trade data between China and the US. So it does look like US-Chinese trade is basically plummeting. But we knew that was going to happen, so to speak, but it's kind of like a slow motion car crash, if you like. And we're going to talk about it in a few minutes, but we're just waiting for other data. So there was job data, that's job openings, which were kind of weak, and but not that bad. But it just feels like there must be some impact, or a large impact, from a higher global tariff burden, and we're kind of just waiting for it. And I think that's the main questions that I've been asked from clients this week, is like, when would you start to get short on diesel or on crude?
Yeah,
and we'll try and pick that up in a few minutes.
Yeah, sure. More talk as well of potential secondary sanctions on Russia. What are your thoughts on that?
Yeah, I mean, I don't know about you guys, but I've sort of been distracted from that topic from the last few weeks, because there's a lot of back and forth, and a few more questions this week just regarding, okay, Trump's getting frustrated with both sides, both Russia and Zelensky, and what would happen if he actually, as a negotiating tactic, wanted to put extra sanctions on Russia, what would they look like? And I think, one potential answer is, well, could it be this kind of secondary tariff, secondary sanction hybrid model again that he's used on Iran and Venezuela? Maybe, maybe not, but it would be a bit more interesting this time round, even though he's not pulled the trigger on the other ones, because Russian barrels are more spread out, right? There's a big chunk that goes to India. The diesel goes all over the place by now, including in Turkey and Brazil and Africa. So that might be a bit more of a headache. And, if kind of India suddenly says, okay, we're not buying Russian again, that becomes a more interesting prospect than on Iran, let's say, where most of the barrels go to China. But would he do it? No idea.
Yeah, fair enough. I think it just sounds like one for us to keep kind of track. And you're right. It has been one of those that hasn't come up in conversation, I guess, in the last few pods, mostly because we've had kind of bigger things to talk about, but one to watch. And OPEC Plus meeting May the 5th. Yeah, any thoughts heading into that one?
Well, yeah, and there's usually loads of commentary, and there's a kind of suspicion, particularly regarding comments from Kazakhstan earlier this month, that they might pull the trigger on another bigger hike versus what was originally planned. I think that can only be met with further weakness in price, right? It's just not a bad signal. It shows you that cohesion is weaker, I suppose, and you can talk about market share arguments all you like, but those are kind of medium term things, and in the short term it just means more weakness, and that would be a good segue for us to talk about what's happening in the Dubai market. Like, Dubai spreads have just absolutely collapsed already, and it already seems like the physical situation is weak.
Yeah, fair enough. We've actually got quite a big section on crude kind of coming up. So June, Neil, looking forward to hearing your thoughts around that. But look, one of the things that we ended the pod with last week was some conversations around where kind of we think mispricing is in the market, and then we also touched upon kind of where would you guys get a bit more bullish going into summer. I kind of want to reverse that this week and talk about more of the bearish signals. So quick theoretical question before we jump into the physical markets for us, so we can go around the table on this one. But look, assuming we're heading towards a recession of some sort, which is well documented, what are the key triggers that we're watching for that would make us more bearish kind of in the commodity markets? I don't know, June, Neil, which one of you want to start?
Yeah, I can start us off. My thinking around was is that surely you see this first in products, right? So diesel and naphtha would be obvious ones. I suspect, if I had to put money on it, I suspect what might happen is you get more surety on how bad the macro data is getting, and that's your signal about forward demand assumptions, right? And not necessarily prompt. So the prompt still looks tight in diesel. Before you want to short spreads and stuff like that, you have to be sure that we're actually building. But I think one scenario is you start to get bad employment numbers, PMIs start to drop, your kind of trucking indices and things like that start to drop off, and then cracks will suffer, because that's the kind of cracks represent the global balance more so than spreads do. Yeah. So I think that's the way I would have seen it, but it's not happened so far. And June, maybe that's where you could come in. That's what I was thinking about crude. Like, first, I wouldn't want to be short crude until margins get weak. But to a certain extent, margins are looking kind of strong again because crude's already weakened. So what do you think? Maybe it could be a crude-led downturn in the market.
No, I still think, we it seems very strong, right? Refining margins right now. And doesn't seem to be a recession signal at the moment. But we've already started to see the Dubai spreads and deferred Brent spreads coming off. OPEC supply hikes will exacerbate that. And I think we'll cover that again later. Yeah.
Fair enough.
Yeah, it's confounding just now because OPEC are adding 500,000 onto the market in terms of supply.
Yeah.
So it's not necessarily a demand signal. It could also be a supply one, just from a very high level perspective.
Yeah, fair enough. What about gasoline? Any thoughts kind of around what we're looking at, or is it literally just the demand leading indicators again?
I think it's just that it's worth just keeping the high level arguments in place. So no road fuel fares well through a recession, right? But if we're assuming it's kind of an industrial trade led kind of scenario, then you would, I guess, want to be relatively longer MOGAS than you would diesel. And we're now going into the summer, which is anyway better for MOGAS. And prices are low, and that kind of, you would talk about demand elasticity being kind of greater for gasoline. And of course, what do people start to do before they lose their jobs? You probably even cut back a bit and stop flying and start driving a bit more. That's not the signal, by the way, in the current jet stance.
Yes. Right.
But, I would love to be, I think just from a high level perspective, you would be, let's say you would be short MOGAS last.
Fair enough.
You know what I mean?
Yep. So still leading by distillate, kind of crude potential supply kind of being added. MOGAS goes last. What about petchems and the naphtha side?
I think we need to see petchem margins weaken. It can be accelerated by the ethane and LPG exemptions, although we just got the report that it's currently just ethane. And also, naphtha is one of the leading market indicators for the macro view.
Okay, so I'm looking at naphtha first then in that case. Anything else we want to add kind of to that in terms of signalling before we move on?
I mean, the only thing is the reprieve, right? So there was a reprieve on ethane tariffs, but LPG so far not, right? So I still think the argument stands for that naphtha demand gets a kick from
LPG replacement.
China. Yeah.
Oh.
So that will also confound things for a short time. But yeah, you're right. I guess the margin is the argument.
Yep, fair enough. Okay then. Well, I hope that gives kind of our listeners a little bit more to think about heading into kind of a potential recession situation. So let's turn this around then back to the physical markets. We're going to take a bit of a deeper dive into the crude market this week. So there's been a lot of movement, and it feels as though we might be at a critical turning point in the physical space. So June, I think you're taking this one. So can you walk us through what's been shifting in the crude markets and why now feels like a particularly pivotal moment, do you think?
I think first of all, Dubai swaps has been weakening. I think it's an indication of looser Asian balances. With OPEC coming in more in supply, maybe more poor demand or expected poor demand as well. So there's a bit of a hesitancy in the buying pattern. Should I know the margin is good right now, but should I really buy and produce the amount of products which might come off later? So in the meantime, we have seen EFS skyrocketed. Last check I had was about 140. Compared to just 30 cents per barrel last week. So nothing upwise is open to the east. CPC was open, the last I checked yesterday, but this morning is already just marginally open. So it's as good as shut, really. So I think it's kind of a precursor to a weaker market in the overall. Yeah. We've seen reports that Chinese imports are strong. But I think everyone has to remember the timing of this imports data that we are seeing. This is all March, April arrivals. And that was back in Jan-Feb buying window. This April buying cycle, which is for June, July arrivals, we actually didn't see that much spot activity. Okay. Partly due to the increase in term cargoes early this month when Saudi gave very favorable OSPs. But also you see PetroChina, they were a very active seller into the Dubai market. And we saw also Dubai window kind of collapsing in the last 2 days of trade. Chinese buyers have now gone quiet. They are going for their very long Labor Day holiday. I think it's like 5 days off. So yeah, we are seeing we are starting to see now the weak market in Dubai.
Fair enough. Firstly, the holiday sounds wonderful, 5 days. Secondly, interesting stuff happening with the Dubai market, but I really like your sentiment about the cautiousness of the buy-in to create products that kind of might come off kind of during summer months. So one to watch there. But look, you mentioned Dubai, obviously, kind of the window collapsed, spreads are softening, but we see the opposite kind of in Brent. So Brent spreads are strengthening. So what's driving that divergence, do you think?
It's quite strange, right? We saw now we're heading to June expiry for ICE Brent. Yeah. The rolls are highly backward. It's close to $1 right now. We have seen indication that 40s is moving east. There is a lack of ECOFIS supply. And on top of that, WTI to Europe flows in April is higher, but the outs were quite wide, and yet we didn't see that actual physical flow coming in prolifically. DFL has, however, weakened about 60-70 cents since our last podcast, and the deferred ice spreads have followed Dubai down.
I must say, June, Neil is kind of very, very happy, kind of off the back of kind of that coming off a little bit. So,
good call.
It's weird, right? Because, well, it's not a good call because I talked about it for months, seemingly. So wouldn't have made any money. But it's weird because now we're getting relatively lower North Sea supply, right? Yeah. Because there's Echo is going into maintenance, and there's sort of articles coming around about how actual North Sea load programs are really low, but the physical Brent's actually starting to weaken now.
Yeah, what about the impact
it's ice?
Yeah, what about the impact of Grangemouth though? Surely that allows a few more cargoes back into the market of 40s.
Yeah, it should do. And Grangemouth is off now. Stopped processing crude. I guess they might have stopped buying already a while back. In fairness, but what I'm trying to say is that it doesn't seem to be, the timing doesn't seem to be right in terms of actual tightness in Europe in crude, or in the North Sea, let's say. And I was reading some articles, you know how you just flick through kind of LinkedIn and Twitter and stuff, and you know you get kind of gems of knowledge from just doing that. And you know, I've seen things about how terminal stocks might have been a bit low in NWE, which possibly plays into this. But let's be very clear. June ice is expiring basically now, and that itself is also disconnected from the spread, is disconnected from DFLs now. And when you look just one month further forward, like the July August spread is 35 cents. It's weak. Like excluding the very front ice Brent, all crude spreads are now weakening. So what does that tell us?
Yeah, I was going to say, actually, if we bring that back then to the physical, so what does that mean for, you know, key North Sea grades like 40s, Albin, outside of Northwest Europe? Are we still seeing that kind of open?
I think 40s looks more open for August into the Far East, but close for July. So it's again an indication of the forward EFS being weaker.
Fair enough. TI Brent, what's going on there?
Neil, you want to take this one?
Well, it's related, right? So I guess it still looks a bit strange to me. So the June TI Brent, of course, we can kind of discount it now because it's so late. But that was particularly wide. It has been particularly wide for a while, and it was keeping landed values of TI into Europe quite low. And then on the other hand, if you just go into July, I could make the argument that July TI Brent now looks too narrow because, of course, the structure in Brent, it means that 40s is landing much kind of weaker into the sort of deferred months. And now TI Afras landing into Europe a bit later kind of look a little expensive. And I think the question becomes, if you assume that Asian demand for TI continues to be weak, which has been the case seemingly for a few weeks already for various reasons, as we've mentioned. Yeah. And TI needs to keep clearing into Europe. It needs to be cheap, and therefore I can see a situation where sort of July TI Brent needs to actually widen a bit now. Yeah. The problem is also at MEH. MEH versus Cushing was really weak for the end of the May assessment, but it's kind of stronger again for June now. Okay. And yeah, that probably needs to come off.
Yeah, fair enough. So that's one to watch then. I know we touched earlier upon OPEC kind of hikes and China imports. Have we got anything else to say on that before we kind of get into a bit more of the physical grades?
Yeah, I think we just have to remember the freight element of it. So all this increase of crudes coming out from OPEC seems to be driving up the VLCC rates. We have seen, for example, TD3C is now up about 8 world scale points since April. So that could be symptomatic of this, change of trade flow.
Okay, so looking for kind of bit of a rebound then on the VLCC rates going forward. Okay, so taking kind of particular kind of grades into account. So we've seen an uptick in DAR blend and pressure on the sweet heavy grades. Are we seeing a bit of a structural shift here, or is this just a short-term dislocation, do you think?
Okay, so DAR blend, for those who were not following the news, it was down for several months now. There was that first export back in February, and then it was quiet again, nothing available. Suddenly, for May loaders, we saw about 3 cargoes of roughly 600 kb each, and it's being marketed quite actively. This DAR blend usually goes into a topping unit direct for LSFO production. With this availability back in the market is pressuring the rest of the sweet heavy crudes. For example, Vincent, an Australian grade, it was sold last week to CPC Taiwan, also for LSFO production. And also we've got the Dangote LSSR likely to come out more in the market with the RFCC downtime. On the Met ECA side, it's happening from 1st of May very soon. And Sparta's view has always been it's only going to be about 1 to 2 Suez max of LSFO blending components flowing to the east as this spec change impact. The Singh and Rotterdam High 5 was at the lowest point in 5 years last week. We made a call that there was going to be an upside due to the 2-week VLSFO cracks, and indeed that spread improved this week. However, we do Hua's call actually. We expect tightness still in Singapore due to the reduced expectation of VLSFO flows from Kuwait and I heard likely as well Brazil, and a close up from Europe. So with all this length in both the heavy sweet crudes and the weak LSFO cracks, it should have been intuitive for low sulfur crudes to also price cheaper into the east. Last week we had the DFL being too strong, so the up was in the end still shut. And this week is about Brent Dubai EFS blowing out. So no, the low sulfur crudes are still uncompetitive to come now to the east.
Okay, all right. Thanks for that, and thanks for the recap as well on DAR blend for everyone. But look, whilst we're talking about kind of fuel oil to a certain extent, one thing that we haven't addressed in the pod for a while is Saudi. So do you have any thoughts around Saudi crude and fuel oil burn, June?
Okay, we actually saw a report that it's dropped by more than 200 kbd in early 2025. That's an 11-year low of combined crude and fuel oil burn. When you look at the details, it's part of this liquid displacement program. The plan is to displace 1 million barrels per day of annual oil burn to free up more oil for exports, improve energy efficiency, and support Saudi's climate and sustainability targets. We need to see whether this trend can continue through summer, but expectation is it should. Okay. On the side of Kuwait, they have something similar called the Environmental Fuel Project, or EFP. But with Alzo fully online, they have switched from from high sulfur fuel oil to low sulfur fuel oil for power gen, and freeing up more high sulfur fuel oil for export. So for the case of Saudi, it's an outright displacement. For Kuwait, it's a switch in quality.
Okay. Thank you very much for giving us kind of that recap. Look, I think, Neil, did you have anything to add there?
Yeah, the high sulfur fuel oil crack's so strong. Like the 180 crack in Europe, it's +3, +4. It's still crazy despite all this. So it's still, I mean, I've been asking Hua about it. He still thinks it's kind of like stock building for summer burn. And I guess, despite all this switching, and I think the HSFO LSFO switch might be done earlier than now in Kuwait, but somehow the high sulfur segment is so strong. And I guess that's one of the, I mean, I'm not fully embedded in that market very well, but typically when you see the sour market coming off, you're kind of thinking, okay, the high sulfur fuel oil market will also come down. So maybe that's one of the signals going forward for high sulfur.
Yeah, and look, there'll be a lag in there as well, right, between the two markets. But look, why don't we get Hua back on the pod next week? I think it would be quite interesting to kind of put his feet to the fire on some of this stuff as well. Okay, so switching over from kind of crude and heavies, we're going to go into kind of more the middle of the barrel and distillates. So Neil, following on from last week then, diesel seems to be holding up despite the broad macro noise that we've got. Is that sustainable, or do you think that we're due for a correction?
So that's one of the key. I've been asked a lot of questions by clients on this week. When do you get short diesel? Because that's the obvious one, as the obvious trade, let's say. And I'm not sure, of course, but I'm just noting that cracks are at a kind of 2-month high. And why is that? And I think it's the same old reasons, right? So the one thing is that the Asian diesel market in particular looks kind of tight, and that reflects also That's also reflected in MOGAS. So Asian MOGAS is also looking pretty strong. I think that's purely a turnarounds thing, because Asian turnarounds typically peak in May, so we're talking about peak turnarounds in Asia. In terms of crude buying, it's a lot different, right? Which also makes Dubai so interesting, because we should be buying for almost max runs soon.
Yeah.
And it's not making a difference in terms of crude. But in terms of products, Asia looks tight, and you can definitely see things like the Sika FOB prices are also up a lot, and I think that's reliance maintenance. And I think that's the sort of main ARB-based bull case for Europe still, because it's been like that for a long time. But the swing barrels are now pointing very east, more east versus west than they have for some time, if you like. And so it's kind of Asia-led tightness, but it's the thing that puts the floor under ice, gas oil, I would say. I think Europe doesn't really want to price too much higher. I mean, I'm quite interested by the fact that, the blackouts this week took all of Spanish and Portuguese refining capacity down, and the market didn't react to that at all, which I think is kind of interesting. Maybe that reflects that people are a bit unsure where the forward balances are going to go anyway. But what do you guys think about that? So I think there's an emergency shutdown in all of these refineries. How long does it typically take to come back?
It was quite interesting what you said about kind of the market didn't react, because I guess kind of the market probably anticipated that it was going to be a short-term problem with power outages anyway. So it wasn't as though it was uncertainty about kind of when things were going to come back up. It was the whole of Spain and Portugal are pretty much out. We need to do something very, very quickly here and turn it around. So look, when you go into an emergency shutdown like that, no asset kind of does very well, if I'm honest. Despite the fact that they've all planned kind of for it quite considerably, but bringing it kind of offline in one bump can cause problems. But look, most of the units are probably still hot. Bringing them back up online is probably about a 48-hour thing if all goes well, and that you don't get kind of unnecessary outages kind of from that. But the second part then is actually kind of, it's all well and good kind of being able to process kind of crude through and produce products, but it's the point at which you produce on-spec product is the key. And that can take kind of a little bit of time after that, so 48, 72 hours, depending on if you've got kind of a successful restart in that as well. I mean, June, you've worked in a refinery kind of more recently than what I have. My days are about, goodness, 15 years ago, nearly 20. This is not good. But what are your thoughts on it?
I agree with the startup timing, and I think, but however, we usually have inventory catered for such unplanned situations, and it should cover that period of the 2 days, 2+2 days of startup to on spec. However, in this current situation, we're talking about multiple refineries all trying to restart at the same time. So the likelihood of one or two having that difficulty to get on spec products or have suffered some kind of damage during the emergency shutdown is a likely high risk in terms of product shortage.
Yeah, I mean, there's going to be a lot of gasoline components kind of being sold out, off-spec naphtha and probably some fuel oil blending to be done if they can get those barrels out kind of to the market. So it's definitely a one to watch. But June's right, actually. I didn't consider that actually it's not just one asset, it's a collection. So, yeah, bit of a high-risk situation there. So let's see how the market kind of reacts to that.
So the risk is high that something doesn't come back, let's say, straightforwardly. I'm just starting to question my own view now. Like, maybe I could, it's always good to do that live, but maybe the European, maybe cracks are the fact that cracks haven't responded that much this week. I mean, I know they're at a sort of 2-month high, but that's been building over the last 2 weeks, let's say. Maybe despite all these outages, the fact that Grangemouth is down, there's German refineries closing, Dangote is having issues with its RFCCs, and what else have we got? The Ecozone starting up.
You're literally you're borderline bullish here, Neil.
No, but maybe I was, but I could make the argument that cracks are surprisingly unresponsive to all these things, and maybe that's because demand is actually not that good, and that's what I mean. Maybe I'm starting to question it now, as I always do. Maybe demand's not that good already. Despite all these one-off factors. So let's see.
Okay. Yeah, there's plenty of bullish kind of really short term kind of incentives there, I think. But
Yeah.
you're right. One to watch kind of on the forward cover for demand, I guess, kind of going forward with some stats, fingers crossed, to back it up. What are your thoughts on Jet, Neil?
Yeah, so Jet looked pretty buoyant, I would say. So that was one thing to also be generally bullish about for distillates. Of course, Jet's a small market, right? So any, let's say, tightness in Jet can usually get mopped up by the size of the diesel market. You just end up pulling some molecules out, right, essentially. And that's actually what you've seen on the US stats. So US jet, the Gulf Coast jet yields have been rising at the expense of diesel and gasoline, seemingly, just looking at the stats. But yeah, the jet east-west is looking quite different to the diesel east-west. So Asian diesel looks tight, but jet east-west has weakened a lot. So west is pricing up. And spreads in sort of Northwest Europe looked a bit more bullish than the underlying gas oil. And just looking at some of these fundamentals, right? Obviously, we're going into summer. That's good for jet. And the stock picture looks remarkably different in the US than it did a month ago. So there was a big overhang in jet, and that got almost entirely cleared. Yeah. And the one thing that looks interesting, and people have also been sort of asking me about it, is the US jet demand indicators, the weekly implied numbers. They're absolutely skyrocketing. They're up, something like 20% year on year, which is obviously not true. And you should always sort of question the levels here. But there's obviously something interesting in jet demand in the US just now. Maybe it's one last holiday hurrah before a recession, something like that. So that's also something to be relatively bullish about. But it'll get mopped up quickly, I'm sure, in terms of pricing. And the last thing just to mention before we start signing off is the Pad 1 situation. Yep. So I think we mentioned it last week, and since then the HOGO did price up even more, and NYMEX heating oil spreads were spiking over the last few days. They corrected yesterday. I still think it could get interesting. So I saw that the API this morning or yesterday predicted another draw in US distillates. If part of that gets reflected in Pad 1, it could get very interesting. And the classic solver for this thing would be to start to draw in cargoes from Europe. So for that, you need the HOGO to price up so you can get that to happen. But we're nowhere near those levels yet. But it has been done in the past. In 2022, there were huge spikes on NYMEX heating oil, and they also pulled up RBOB spreads at the same time, if I recall. So I still think that's possible. But you have to contrast that with the Gulf Coast. I started to look at that a bit more in detail this morning. And one of the funny things that's happened is the Gulf Coast FOB prices have dropped a lot. Also, the US Gulf Coast 10 diff to the NYMEX basis. And that really looks like it's trying to keep the ARB to Europe open. And I'm trying to relate that back to the fact that Brazilian premia have dropped off a lot. So it seems like there's weak demand in Brazil for marginal barrels, and the Gulf Coast seems like it wants to export a lot. So I was thinking, okay, everyone knows the Gulf Coast stocks are tight, US distillate stocks are tight, but it might also be the fact that they're trying to clear volume exporting to Europe. And that, to me, is what Gulf Coast pricing looks like it wants to do over the last week or two. It wants to keep pricing into Europe. And that's what it's been doing essentially for the last month. On and off, the ARB has been open, and it's sort of, on average, much more open than it's been for most of the year so far. So, yeah, I don't know. Maybe I'm starting to convince myself over the course of this pod that actually we should get bearish again.
There it is.
There it is. Yeah, exactly. Can't help it.
Yeah, we're back to it. Okay. So still short-term bullishness in the real prompt with signals. Neil's getting more and more bearish kind of as the minutes tick by on this pod, for sure. But look, one thing that would be really good. We haven't got time to cover kind of a full gasoline story this week, but it might be quite interesting actually to get kind of gasoline back on the pod next week, and also with fuel oil as well, because as I said, Hua's made some cracking, excuse the pun, calls of late. So it'll be great to kind of hear his thoughts on where we're at. But look, anything else that we need to consider before we wrap up here?
Are we getting bearish crude? do we need to be bearish? It's already happened.
I know. I was
Maybe
going
it
to
can
say.
go lower.
Yeah, I think that's going to be an interesting one for next week, actually, kind of whether we continue this trend lower or not. But I'm very delighted kind of that your crude market swung the way you needed it to, Neil, after weeks and weeks of discussion. So that's great. So,
well, just to say, like, obviously I don't know what's happening in the Brent complex, right, in terms of what people are doing. But it is easy enough to identify when something looks odd, let's say. Like if the rest of the global physical market seems to be coming off and the DFL spiking to unusual levels, then, it's kind of easy just to say, oh, this looks a bit strange. And I think that's all about all we can do, really.
Yeah, and I think picking up kind of where we see the market mispricing kind of next week. Certainly we will continue to watch it for crude, but let's take a look at kind of the light ends part of the barrel and kind of some more of the heavier stuff as well. So look, thank you very much both. That was super insightful. So that wraps up this week's episode of Sparta Market Outlook Podcast. If today's chat helped bring some clarity to the noise or give you a fresh angle to think about your positioning, we'd love to hear it. So as always, feel free to share the pod, drop us a message, and make sure you're subscribed so you don't miss what's coming next. So until next time, stay sharp, stay curious, and keep your positions nimble. Thank you.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.